As of 10:29 a.m. Eastern Time, Lemonade Incorporated, ticker LMND, is trading at $71.63 per share. That is not a typo. That is a massive move, up $13.01 on the day, a surge of over 22%. And let's be absolutely clear, what you are looking at is a public execution. This is the market, live and in real time, taking a massive consensus short thesis out behind the woodshed. This $71.63 price isn't a rally, it's a reckoning. The immediate reality is that Lemonade, a company most of the professional world had left for dead, just delivered an earnings report that has completely broken the bear case and is forcing a fundamental, violent reevaluation of the entire company, all in one morning. This 22% surge is the sound of 1,000 short sellers, many on Interactive Brokers, trying to get through a very small door at the same time. For the last 3 years, the expectation for Lemonade was that it was a failed experiment. This was the poster child of the 2021 bubble, a stock that defined the story over substance craze. It was the AI insurance company that got huge hype, listed on the Robinhood app, and became a favorite for self-investing individuals, only to proceed to lose more than 90% of its value from its peak. The narrative on Wall Street and among serious investors was that this was a tech company pretending to be an insurance company. And insurance, as it turns out, is a hard, brutal, capital-intensive business. The common belief, the one that built that massive short position, was that Lemonade's AI Maya and AI Jim bots were just marketing gimmicks. The bear thesis was simple and compelling. Lemonade was fast to pay claims because its AI was naive and couldn't tell the difference between a real claim and a fraudulent one. They were suffering from adverse selection, meaning their easy-to-use app was attracting all the highest-risk customers that traditional insurers had rejected. The stock was a show-me story that never showed anyone anything but massive losses and a skyrocketing gross loss ratio. This was a name that Fidelity Wealth Management wouldn't touch with a 10-foot pole, a stock that was poison in any serious Intelligent Portfolio or Schwab Intelligent Portfolio strategy. The expectation was that this company was on a clear path to insolvency or a desperate dilutive capital raise. But the reality, the one that is smashing that narrative to pieces this morning and causing this 22% explosion, is the Q3 earnings report. The numbers are frankly stunning. Lemonade just reported a gross loss ratio of 68%. Let me say that again, 68%. The Wall Street expectation was for 75%, and even that seemed optimistic. This is not a small beat. This is a fundamental paradigm-shifting number. It signals that their underwriting, their AI, their data modeling might actually be working. It directly refutes the entire adverse selection bear thesis. It suggests that after years of feeding the AI with data, the machine is finally getting smart. But it wasn't just that. They beat on in-force premium, which grew 25% year over year. They beat on revenue, and most critically, they massively beat on adjusted EBITDA losses. The cash burn, which was the ticking time bomb, is slowing down dramatically. The company's adjusted EBITDA loss was the smallest it has been since going public. This is the first tangible, numerical proof that the business model, the one everyone laughed at, might have a path to viability. This $71.63 price and this 22% move is not about fundamentals from last week. It's about a complete repricing of the future. For years, this stock has been a battleground. You have the retail bulls, the long-term believers, many using their SoFi Invest or Fidelity brokerage accounts, who bought into the story of disrupting a $5 trillion industry. They were the ones holding the bag, averaging down from $150. And on the other side, you had a massive entrenched institutional short interest, one of the highest on the market, who saw a cash-burning gimmick. The stock has been trapped, trading on sentiment, not on numbers. Today, for the first time in its public life, the numbers are backing up the bulls. This is the kind of event that doesn't just change the stock for a day, it changes the entire story. So what does Lemonade do? For those who just see the ticker, this isn't a traditional insurer like Travelers or Chubb. Their entire model is built on technology. You download the app, you chat with an AI bot, and you can get a renter's or home policy in 90 seconds. When you file a claim, another bot can process and pay it in as little as 3 seconds. Their business model is also different. They take a fixed fee from your premium. The rest goes to pay claims, and whatever is left over, the underwriting profit, is given to a charity of your choice, their give back. The expectation was that this was all a clever marketing gimmick to attract millennial and Gen Z renters, a demographic that is notoriously unprofitable for insurers. But the reality they are trying to sell, and which the market is finally buying today, is that this tech-first model does two things. First, it allows them to acquire customers at a much lower cost. Second, and this is the entire investment thesis, it allows them to land and expand. This land and expand model is the whole story. They get you with a cheap $10 a month renter's policy when you're 25, using the SoFi trading platform or Robinhood. They give you a great experience. Then, a few years later, when you buy a car, you add Lemonade Car. When you buy a house, you add Lemonade Homeowners. When you get a dog, you add Lemonade Pet. This is the path from a low-value customer to a high-value, bundled customer. This is how they compete with the established giants. This Q3 earnings report, with its shockingly low loss ratio, is the first concrete proof that this land and expand strategy isn't just theory, it's working. The new products, like home and car, are scaling, and crucially, they are scaling with good underwriting. This isn't a high-growth, high-loss story anymore. Today, it became a high-growth, improving profitability story. That is a completely different company, and it demands a completely different stock price. This isn't a stable Apple stock or a hardware cycle Nvidia stock. This is a company in the middle of a high-stakes all-or-nothing validation, and today it just passed a major test. This brings us to the future outlook. Where does it go from $71.63? The new expectation, the one being formed right now as we speak, is that this is the bottom. This is the inflection point. The bulls will argue that the 68% loss ratio is not an anomaly. They will argue it's the lagging indicator of years of AI learning. They will say that as the AI gets smarter, that loss ratio will continue to drop, heading toward the company's long-term target of under 60%. They will argue that the cash burn is now under control, and the company has a clear line of sight to profitability without needing to raise more cash. This is the blue sky scenario, and it's what every bull on their individual brokerage account has been dreaming of. But the reality is that one quarter does not make a trend. This is still a company burning cash in a high interest rate environment. This is still a tiny player in an ocean of giants. The risks remain enormous. What if this quarter was a fluke? What if a major hurricane season next year or a series of wildfires hits its customer base and sends that loss ratio right back to 80%? What if the legacy insurers, who are now all building their own apps and AI models, decide to crush Lemonade on price? This is why you will not see this stock in Fidelity ETFs or Fidelity mutual funds tomorrow. It is not a safe bet. It is still a high beta, high risk wager on disruption. The $71.63 price is high, but the 22% move means the cost of betting against this company just went up exponentially. This company is betting its entire future on AI-powered underwriting. I want to know what you think. Comment below with a yes or no. Do you trust an AI to approve your insurance claim? So, to wrap this up, as Lemonade explodes 22% to 71.63, you are watching a market in the middle of a panic to reevaluate. The expectation for years was that this was a failed, cash-burning tech gimmick destined for the dustbin of market history. The reality, delivered this morning in the Q3 report, is a set of underwriting numbers so strong, so far outside the bounds of what anyone thought was possible, that they cannot be ignored. This $13 surge is the market acknowledging that the AI, the bots, the giveback, the entire premise of the company might actually be working. The disconnect between the old, broken stock narrative and the new, we're fixing it reality is what's causing this violent move. And the only question that matters now is whether this is a one-time miracle, a dead cat bounce fueled